trading can be as simple as A, B, C, and D. In this video, I'm going to show you how you can use these very simple swing patterns within the markets in order to find excellent places to enter and to define and limit your risk, but also maximize your potential gains. Now, on the screen in front of you, I'm going to show you an example of a trade I'm actually in at the moment. And the way ABCD trading works, it's based upon Elliott wave theory, and you identify an A and B leg of a move, so the A to B leg, and then you identify a B to C leg, and then you identify that price should travel from C to D. So you can see in this example here, I've identified the A to B leg of a move, then we have the B to C leg, and now I'm making a move up towards the D leg, and my targets there, which you can see, is an extension of the A to B leg, and the C to D leg should be in equal length. So that's my ultimate target. Now, I'm not going to explain how I'm going to play this as it goes out, but that's my ultimate target. All I want to explain to you is simply how you go about identifying these A, B, C, D legs. If you look in the market, you'll see these everywhere. So first of all, when you see an A to B leg, like you do here, you get a fib retracement level. You just go left to right. So you've got A, B leg. Now you're waiting for the B to C leg to finish. And the way you would have sort of worked this out is you would have seen that price went down here, and how do you know where the C to D leg is going to be? Is it the 38.2? Is it the 50 or the 61.8 level? They're the three sort of main levels you want to be entering a trade on. So in this instance, what you can see is that price went down to this area here, and then when the stochastics started turning to the upside, then we're starting to move in the direction that we wanted. Now, you may have got in here at this level here when price just broke above here. You see stochastics turn to the upside. You might have broken here. Now, that wouldn't necessarily have been wrong because you hit the 38.2 fib, but if you think about it, you would have had to have quite a large stop, wouldn't you? So ideally, you would put your stop underneath the A leg, but that's a huge stop, isn't it? Look, that's 1.08 to 1.04, so that's 400, 500 point stop. See, what I'll be inclined to do is once price broke above this EMA and rejected this level, just put a stop underneath there, because you can always re-enter. And you could have waited for price. Oh, price goes down, and now enter here, which is what I've done. I entered here. My stop is running beneath those lows there. That's another extra position. That's just a break even, so ignore that. But my main stop for my main position is here below that area, and I'm looking to target these highs here at the D leg. Just show you another example, ABC trading. Here you can see here's the A to B leg, then B to C leg, and then for me, my entrance, if I was trading this, I would have traded here. Stochastics have turned to the downside. I use the settings 10, 3, 3, and stop running above the high, or more for me, I would just do it above these highs, and then you're trying to trade an extension of that A to B leg, C to D leg. So have a look for those kind of things in the markets. Look for basically look for prices making new highs or new lows. That's the kind of best example of this. Like you can see here, like A, B leg, C, D leg. Great. But what's interesting here is this leg here, because you can see it's making new lows. So A to B, B to C, and then C to D should be exactly the same length as the A to B leg. Hope that helps. Hope it gives you a way of thinking, and it's just a brief introductory video on how to trade and how trading can be as simple as A, B, C, and D.